Good morning to everyone, and welcome to Behind the Markets. I'm your host, Munyumba Mutwale. I will be and should be joined by my co host, Vernon, at any given time during today's show. But today we'll be covering Enterprise Thursday for as many of you as possible. And once again, a good morning to as many of you. It is Thursday, the 4th of May. We call this Star Wars Day for the statement, May the 4th be with you. So just remember that today is actually, for those of you who are old enough to know the Star Wars trilogies, or the Star Wars, not trilogies, the Star Wars series, today stands for the Jedi Day, standing for May the 4th be with you. So for all of you who made there, may the 4th be with you. May the 4th of God. May the force of God. It sounds like obviously you're saying it like Mike Tyson, but for everyone who's joining us today, give us a shout out of where you're joining us from, name, where you're joining us from, and a good morning to all of you as we get rounded up into the early reads of the market. Now, getting kickstarted on today, it is Enterprise Thursday. As we said, May the 4th, we're going to be talking about essentialism in business in general. But today, as I said, the first step we get cracking onto is the markets itself and the weekly market roundup. Now, the weekly market roundup does consist, this morning does show that the Kwacha did lose a bit of value, again 0.28%, but we are seeing a slower devaluation than the last time. We were seeing quite hectic moves, but we are seeing a slower devaluation, though steady, somewhere around 0.23, 0.3, going all the way up to 0.5%. We are down, the dollar is down 1.22% year to date, but still down 16.5%, shredding away any gains that it had earlier this year. So we are seeing closing at about 17.8768, but not moving as rapidly. So there might be some resistance coming from the earlier statements, I think, that came during the week regarding the official creditor committee meetings that are scheduled going forward. So I think we all just need to pay attention to maybe what that will actually yield. Whether anything will come of it, that's a different story. We did see the stock market yesterday move up by 0.96%, thanks to Standard Chartered moving up close to about 20%, up 15.54% actually. The stock is actually doing quite strong as well. Probably now, the expectation is, could it be bouncing off results? Could it be reacting to other things? We're not too sure. But we did see Standard Chartered shares move up to 1 kwacha 50 yesterday, up 15.38% for the shareholders. Now, year to date, we are seeing Standard Chartered shares up 13.6%. Though up 15.4 for the year, so they did dodge down a little bit, and they've actually come back up. So the highest they've been for the year, and to be honest, if I'm looking at it correctly, this is the highest we've seen Standard Chartered shares for as far back as well. We did see them this high in February 2022, but these are the highest they've been in counting. And this is the highest we've seen Standard Chartered shares holding, at least since the collapse of the stock back in May 2020. But remember, the all-time high of Standard Chartered shares is somewhere around 2.81 shares. 2.8 2 kwacha 81, and we're back in 2017. But obviously, there's been a steadily move down in market share. But we did see yesterday it did bounce off pretty strongly, moving the stock exchange. I remember it's one of the billion kwacha stocks. And whenever you see a billion kwacha stock move, you actually see most of the stock market move with it. Now, there was Standard Chartered was joined by Copperbelt Energy Africa, but that's not an indexed share generally. But year to date, you are seeing that the stock market is up 0.9, is up 10.32% year to date. So this is actually good news, because we're actually seeing now the stock market generating above 10.32% year to date. Now, we did see that the bond index moved up by 0.1%, with the USD version of it moving down by 0.4% due to the devaluation of the kwacha. And you also saw that interest rates barely moved yesterday. There was barely any movement in interest rates as of yesterday. Now, in terms of rands as well, we saw the rand go up by about 0.91%, mainly due to a stronger rand. And the rand did rally yesterday as the Central Bank of America did raise interest rates. So we did see that it was baked into the price, but based on the fact that the Central Bank of America is now fitting to try and see if it can pause. So the Fed is now starting to signal where they want to start assessing any of the damage that could be done when it comes to this. So the assess so that they're now fearing an economic slowdown, and this came out even on Yahoo News yesterday, where they did say that the Fed is now trying to assess whether it's going to make whether there has been any damage to its the U.S. Fed raises rates, but signals that it'll pause to assess the banking failures that are going on. Yesterday, as obviously the FOMC meeting did go on, and they did give their rates announcement. Federal Reserve Vice Chair of Supervision Michael Barr, Federal Reserve on Wednesday, did raise its rates by a quarter of a basis point, but signaled that it may pause further rate increases, giving officials time to assess the fallout of recent banking failures and wait for a resolution of the political standoff of the U.S. debt ceiling to monitor the course of inflation. So inflation has been coming down, but it has been sticky. But they did actually move from 5% to they have moved the range to about 5% to 5.25%, the 10th consecutive rate hike since March 2022. But they are now trying to see what are the implications to the banking sector with banks like First Republic Bank, which has been failing and is now getting sold to JP Morgan. While we also saw Silicon Valley Bank absolutely just capitulate. So they are worried that any more rate hikes might cause some irreparable damage. So they're trying to slow down here to make sure that doesn't happen. And as a result, that's why we're seeing the Rand trading up by 0.91%, because a lot of the risk-on currencies or the risk-on assets are starting to now get back into the game, because they're now monitoring to see if the Federal Reserve is going to now instill a pause. Now, next thing that we're seeing on the markets is we are looking at our bond index, as you said, up 0.1%, and year to date up 9.52%, and on the month up 4.06%. In dollars, our bond index up 10.81%. Remember that it has been sliding down. It did touch 300 for a little bit, or 1.6% below its all-time highs. On the month, it's still up 24.65% because it was digging into the negatives for a while the interest rates are still sitting up 0.38% year to date, but down 0.002% as of yesterday. So the bond market is sliding along at a steady rate, but still above inflation. That's the good part. Remember, inflation year to date is about 6.8%. So we are seeing that going forward, we are seeing that 9.232% is still 3% up year to date. And if you kind of extrapolate that throughout the year, then we're looking at about 9% above inflation year to date, which is in line with how bonds perform in general. And the stock market is above inflation by about 4%, which is about 12% above inflation, which is just in general. So markets are moving at the regular pace that we are used to. We did see commodities yesterday slide down, copper down 8,459, mainly due to Caxton data coming out of China, showing that Chinese manufacturing data was a little bit weaker than expected. Actually, Chinese manufacturing has gone into contractionary territory. We also are seeing that the barrels of oil are down to $72, but mainly due to a rate hike and also due to Chinese economic news, as we pointed out yesterday. So the portfolio of metals are not doing too good. Now, we did see that gold is up 0.67%. Obviously, the hawkish Federal Reserve, or the slightly dovish tone of the Federal Reserve, expecting to pause on interest rate hikes, has also spoken to those who are kind of just saying maybe we need to keep gold because there might be something worrisome here. But we have seen that all of the commodities are up early this morning. Brent oil has actually snuck back up to 73, and copper has actually snuck back up to 8,500, up 1%. While gold is up 2,048, it's also up 0.5%. And year to date, these assets have been performing quite strong. Year to date, we have seen that oil is down 14.97%, copper is up 2.3%, and gold is up 12.21%. These are year-to-date readings that we're catching here. And on our readings, we're actually seeing that copper, as of yesterday, copper was only up 1.04%. Gold, oil down 16.19%, and gold up 11.4%. So these are the current readings I was giving you earlier, and these are the current ones we're seeing right now as it is. So we are seeing a slide slightly back upwards. Now, in terms of your wealth insurance assets, cryptocurrency has bounced back up above 500,000. Remember, it did dip down below 400,000, but it's kind of slid back up to 500,000, but down 0.9% yesterday due to crypto sell-offs. While we also saw Ethereum also selling off 0.6%, but gold is back up 0.95%, up 10.05%. Now, the year-to-date readings across the various asset markets, we are seeing that bonds up 9.5%, stocks 10.3%, gold 10%. So we can see that the mainstream assets are kind of in the same read, but we're seeing that obviously our crypto assets, which are our wealth insurance assets, they're up 68% and 52% respectively. But remember, those are highly volatile assets, and you cannot jump directly into trading them thinking that you can put all your wealth in them. We always recommend no more than 5% of your portfolio in there, just to make sure, because those are experimental assets that you're paying attention to. Now, in terms of the rest of the markets and how they were reading, we did see that the tailwind, the headwind on inflation was that crude oil inventories were up 1.2 million barrels. However, obviously the reads on the market have been keeping crude oil negative, especially due to Chinese data. We did see tailwinds in the interest rate market, where we saw a reduction in treasury gilts in the UK, and we also saw mortgage rates in America down 0.05%. This is good news after continuous movements up, but then Federal Reserve did push up interest rates by 25 basis points. But the good news is that they're looking at trying to slow that down. So in the interest market, we are starting to see a little bit of a slowdown. This aggressive rate hiking looks like it's losing a little bit of steam. And that's good news for us, because remember, we're trying to get offshore investors back into our bond markets, especially since NAPSA is no longer a big player in our bond market at the moment, specifically because NAPSA cannot continue being the big supplier of our bond market, mainly because NAPSA makes up 31% of deposits in banks, fixed deposits in banks. Now, banks got very used to using that 31% of fixed deposits for investing in government bonds. Now, unfortunately, what that's done to the banking sector is that they can no longer do that as easily, because NAPSA needs those fixed term deposits specifically to allow to transfer to people for NAPSA payments. We have seen recently that NAPSA payments have now passed the 1.3 billion kwacha mark. And we're actually seeing that a lot of huge payments are starting to come out. Now, one of the quick things I'd like to share very quickly coming off of that is how much money has actually been injected back into the economy. If you can actually see this, we're seeing that about 1.3 billion in NAPSA pre-retirement withdrawals have been punched back into the economy. 0.8 billion or 800 million kwacha worth of Zambia National Provident Fund benefits payouts have also been done, which make up about 2.1 billion. And then 3 billion of dismantled GRZ arrears to companies in the country have also been distributed. That's 5.1 billion kwacha just year to date that has been injected back into the economy. This is money that's been held up through pension funds and through governments not paying their suppliers, and that's obviously now rushed back into the economy. Now, could that be causing inflation, or could that be giving room to run for growth? That we expect to see on the other side of it. We're not too sure, but we are seeing strong performance. We are seeing that this might jolt the economy into a strong performance. So this is actually coming from the budget and also coming from NAPSA statistics that are coming out. But what we're trying to say is that banks can no longer be the primary player banks can no longer be the primary player in bond auctions, because NAPSA can no longer play that strong. So there is a need for offshore investors to start coming back in, and a Fed pause might speak to that. Now, remember, this is the Fed interest rate is sitting at about 5.25%. This means that a lot of American investors are much more comfortable making long-term investments in fixed income assets in America, because they're making it at over a 3% interest rate. Now, whenever people are getting more than 3% interest, they are more comfortable in their own country. But should that start to come down eventually, then we'll actually start to see whether or not the Federal Reserve, whether or not now offshore investors can start sneaking back into our markets, and therefore now pushing our interest rates down. That's an outlook which we may have to look out for. Now, in terms of trade and international activity, we did see Italian unemployment come down by 0.1%. European Union unemployment also came down by 0.1%, and ADP farm data in America also pushed up by 154,000 new jobs. So we are seeing that the job market is actually still strong in the global economy, especially the developed economy. Also, good news in the industrial sector is S&P Global Composite PMIs show that the global manufacturing sector is still in growth territory, up 1.1 points to 53.4, showing upwards. However, Chinese Caxton manufacturing PMI read went into negative territory, slipped back into negative territory, giving a bit of a shake to the global economy. And this was yesterday's Four Horsemen outlook. And finally, let's take a look at some of the stories that have actually cracked some of the sectors today. We did see that Zanaco edges out ABSA in Q1 banking sector results. We'll be going through that just now. NABSA crosses over 1.3 billion in terms of payouts. Actually, yesterday they did say that 100 million kwacha worth of payouts were done. 100 million kwacha worth of payouts were done just between 5 p.m. and 9 p.m. yesterday. That's how big this is actually working. Now, I think some people have been asking why some people are having a case doing this faster than others. What we have been notified is that because NABSA has a lot of deposits in many institutions, it's actually created a link between it and those institutions to actually tell people that to tell them that when somebody makes a claim, we're going to use the deposits that we have in your bank and you're going to transfer them to that person's bank. So that's why banks cannot play that space, because the liquidity requirements of deposits sitting in banks. And remember that NABSA, basically, as I said, is about a third of banking deposits. We're looking at about 13 to about 15 billion kwacha worth of banking deposits are sitting in NABSA. Are coming from NABSA. So one in every 3 kwacha deposited in a bank is actually coming from NABSA. Now, NABSA has about 11 billion that could be paid out, and has 14.9 billion, sitting in banks. So they basically need as much of that 14.9 billion just in case everybody comes to claim their 20%. Now, one piece of advice I would give to as many people as possible regarding this NABSA withdrawal is that you may want to consider, for those of you, I know that I did give you 3 areas where you can invest the money: your ideas, your assets, and yourself. Those are very good places where you can invest the money. Now, one of the things that people should be wary of is trying to see what is the best age to try and time this. I would say that as long as you're above 45, okay, this is a decent place. This is a decent way to try and time it. And the reason I say, not above 45, between 40 and 45 seems to be your sweet spot of where to actually withdraw, at least if you've done 200 contributions to your NABSA. The people who have done 200 contributions or more are the ones who, yes, you are going to have a pension salary. Okay, I want you to put that into your mind. You are going to highly have a pension salary in your life. And as a result, what that means for you is that you're not going to be able to obtain a lump sum. To anybody who's 40 to 45 or at least above that range, and especially if you're about to retire, take the withdrawal. My advice is, if you're going to retire, take the withdrawal. That's a huge lump sum that you might be able to have access to, and then you utilize the rest to get your pension. So take the withdrawal if you want to do something significant maybe, or you want to move it into an asset portfolio. Because one of the biggest problems with the annuitized pension structure is that when you pass away, those are not benefits that can be transferable to anyone. So you want to extract as much of it as possible to try and make sure you've got it in a state that is actually transferable to your next generation. Maybe you want to save it for the next people, whatever it is. But my advice to as many people as possible is to hold the withdrawal decision to somewhere in your 40s, or at least 200 contributions, which should be about 16 to 17. So, which should be about 16 to 17 years worth of contributions. That should be the sweet spot of where you should be withdrawing from. However, I can't really tell you what to do. I'm just giving you my advice on that one. Now, we are seeing that NABSA has crossed over to 1.3 billion. People are getting quite a lot from there. Afrexim Bank yesterday did launch a $3 billion development program with Kenya to boost it. So this is why I'm saying $3 billion Afrexim Bank in terms of investments in Kenya, because it's one of the places that it views that Kenya will be a strong exporter. So they're doing quite a lot along the supply chain. The MSCI gauge of stock markets around the world was advancing, but trading was very choppy. While Tuesday's Treasury yields and the U.S. dollar steepened declines after the Federal Reserve raised interest rates, but indicated that it could hold off further rate hikes. We're also seeing that in the major markets, the banking sector's concerns have returned to the spotlight on Monday after U.S. regulators seized First Republic, the third largest institution. Sorry about that. The third largest institution to fail in the last 2 months, with JP Morgan Chase agreeing to take $173 billion of the bank's loans and $30 billion of securities and $92 billion of deposits. So First Republic Bank is going to be acquired effectively by JP Morgan. Their book will be acquired. European Central Bank is also expected to raise rates in its policy meeting on Thursday, which is today. We also saw that U.S. lawmakers have actually backed a bipartisan bill banning or at least limiting the trading capabilities of U.S. senators and U.S. Congress people, because they actually have had a problem with the House of Representative members, or people in Congress, the House of Representative members and senators trading stocks and commodities. So they actually are now limiting the ability of them and their family with something they're calling Restoring the Faith in Government Act, to try and help with transparency, and to not have these people trading securities at a much better rate than even regular people, and also utilizing privileged information. Copper prices are due to recover slightly in the months coming, supported by low inventories. So that should be good news for us, but the upside will be curbed by weak physical demand in China and the threat of a global recession. And oil prices did fall yesterday by 4% on Wednesday, extending steepening losses after the Federal Reserve did raise interest rates. So that is some of the data that we have been seeing. Now let's get into our deep dives for today. First deep dive story that we've picked up here today is that Mr. Aliko Dangote has actually called for the removal of trade barriers in Africa. Now, speaking at the Lagos launch of the specials publication of the World Ahead 2023 by The Economist, Dangote Group was represented by its executive director and group chief risk officer, Dr. Adenike. I'm not even going to try that. Who was actually Dr. Adenike, who was actually now stating that African countries need to dismantle economic barriers that are hindering free trade among the nations, and in order to achieve sustainable growth of development across the continent. Now, Dangote Group has committed $20 billion to investment across key sectors such as agriculture and other areas, agriculture, infrastructure, and energy. They're talking about things like fertilizer plants. They've invested in things such as their 650,000 barrel a day refinery, trying to help if they can now create better backwards integration to help African countries do well. Now, he has pointed out countries like Nigeria. Nigeria is expected to become the third largest population in the world by the year 2050, only behind India and China. Now, they're trying to point out here that Nigeria then should therefore be a booming economy, a booming metropolis. So you're starting to see the push for growth. And he also did state that it's not just in the hands of the public sector to develop the economy and to make sure that things are moving in a sustainable way. It's up to the private sector to make sure that they're not just contributing, they should be leading the charge. And therefore, the public sector is there to support them. Other news that came out is Africa is projected to become the fastest growing region in the world, according to a new report by the Mo Ibrahim Foundation. This report found that 6 out of 10 of the world's fastest growing economies will be found in Africa. The African continental free trade presents a huge opportunity for the continent, with a ready market of 1.4 billion people, surpassing the EU and other regions. Remember, Africa has got a strong, young, vibrant working population that it can leverage off as countries like China are starting to age and slow down. It is a good idea for countries like Africa, countries in Africa, to now start taking that position. It does require coordination. It does require trade. It does require a stronger incentive to actually work together. Regionalism might actually help Africa, especially with the world pulling apart and them starting to be competitive with one another. I would like to obviously take this moment to introduce my partner, friend, Vernon. How are you doing today?
We're doing well, despite the connectivity issue we've had, but we're doing very well actually.
Yes, yes. No, we've caught you in the middle of this. And I don't know if you caught that last piece of news that we had. Story actually stating that Africa is expected to be the fastest growing region with 6 out of 10 of the countries. Actually, if I can go back for a little bit, Vernon, one of the things I did point out is that Africa is it's not just going to be it's not just only Africa specifically. I'm going to say East Africa because East African economic growth is going to be sitting at about 6.13% going forward, 6.31%, sorry, going forward, higher than the African average of about 4.1%. So North Africa and East Africa are going to be the main contributors to economic growth. And especially with that story about Afri-Exim Bank pumping $3 billion or opening up a $3 billion program with Kenya, it does appear that we are getting to a point where the question I keep asking about Zambia, where do we lean? Do we lean east or do we lean south? Southern Africa is going to be the slowest growing part of the economy, with South Africa being the second slowest growing economy around the region, with only 1.5% GDP, dragging the southern region down into slow growth. And Zambia is going to be growing somewhere around 4.7% over the next 5 years, meaning that we should be looking positively. So the question, maybe to you, Verdun, is in your books, which side? And I know maybe I'm kind of playing my hand here, but which side should we lean? I know that we don't have to leave SADC. I know people think I'm always being too harsh when I say should we leave SADC, but the question is the East Africa community is going to have a single currency, borderless trade, mobility of people to move from one country to another. It is going to operate freely and openly and as one region. Okay, one single passport. So in other words, labor mobility. They're gonna have a single currency, meaning no exchanging currencies to trade with one another. It's a big market that's going to just connect with each other. And the and 4 out of the top 7 fastest growing economies in Africa are actually found in that region. So the question, where should we be leaning?
I think for starters, we should prioritize the current situation that Zambia is at and what kind of a Zambia economically we're trying to have at the end of the day. Uh, these two options we have on the table can either break us, and cripple us in the long run, or build us and be able to even help us have more momentum as a country independently. Now, remember that we have been grappling quite a lot with people. I mean, owing people over the past years, and it has been. I was actually looking at some of the performance reports by the minister, Honorable Msokotwane, where expenditure actually did exceed the target for a period from as far as 2021, coming all the way down to 2022. And now, according to the reports, of course, seemingly they're trying to manage the expenditure. And of course, I think the time I was reading that, the first thing that came to my mind was people always, lamenting and wanting the government to be feeding them with money, empowerment, and whatnot. And then now the government has no option but now overspending than actually expected. I think right now, Zambia's economic growth should be a priority for everyone. Both private as well as other sectors as well, to see that we're able to push ourselves in a position that is going to allow
Just
us
quickly on
leverage.
that point. On that
Yeah.
point. On that point. Zambia's growth should be priority. Cool. Now, where are we best served with a faster growing momentum? By trading with East Africa or trading with Southern Africa? Not East as in China. East Africa
Mhm.
or Southern Africa? We are majority a Southern Africa linked nation in
Yes.
terms of our trade. Should we be pushing East because East has more growth opportunities for us? And they are the ones asking for food from us. Now it may cause a bit of inflation, but it's actually the regional demand coming from Congo, Kenya, all these areas that's going to drive up our agricultural sector. It's doing business with Congo to create a EV sector, to try to start connecting EVs. We're talking about tech trading being done with Kenya as opposed to South Africa. So the question is, should we start reorganizing for the purpose of getting a faster growing economy and a more free flowing economy? Should we start reorganizing our trade and economic activity to East Africa, or should we be leaning it only to South, or should we be continuing with this resistance to change model where we're just in SADC like it's a gang? When I ask people why are we staying in SADC, it's just no. Why should we leave? Why should we stay? The question is why should we stay? Okay, it's not why should we? Why shouldn't we leave? You can stay if you want, but
Yeah.
SADC is a dead zone. It's not growing. Like it's actually economically dead. Like everyone here is stuck because South Africa is wedged into load shedding. Okay, and South Africa likes the dominant position they're in, and South Africa is more interested in their BRICS escapades with China,
Yep.
Brazil, all those things. They're now more interested in forming a currency with those ones. If they're going to be forming a BRICS currency, what on earth makes you think they're going to form an African currency or they're going to play towards an African currency? South Africa is playing its hand that it's uninterested in integrating Africa. It's playing its hand. So the question is, should we stick around with this dead zone if we are really pushing growth, or should we start asking ourselves, Congo just literally shifted to East Africa. Okay,
Mhm.
Congo just literally did it. They've just joined the East Africa community, and now they're now working on trying to integrate there. Should we, Malawi and Zimbabwe and Mozambique, just do the same? Allow the SADC that operates the way it wants to, which is that customs union of South Africa, Namibia, Botswana. Let them operate the way they want. Okay, they seem to like operating that way. I call them koihadi. Let them operate that way. Okay, and let us. I would my if any leader was going to be revolutionary in this country, it would be the leader who would round up Zimbabwe. Said Zambia, Malawi, Zimbabwe is supposed to be one country. Okay. And I know people say that's colonial, everything, but that was a good idea. Two, that one country needs to go and join East Africa. That's what I'm thinking.
Well, you see, I think this is a time where Zambians need to be smart. The same way we're smart enough to be smuggling meal to other neighboring countries where we knew that they were in serious need of the commodity. This is the time, of course, we need to be smart. The choice and the options are open. It's either we're comfortable, we continue scrounging with opportunities, finding opportunities, or we can possibly take advantage of what's available elsewhere and see how we can grow ourselves and expand and possibly even learn. I think also learn. Let us not pretend as though we are good at this and we are experts and we're look at how our manufacturing industry is performing and production wise we're not okay. So why don't we pick up on what is already existing and actually what is yet to be quite a very flourishing venture or environment, and pick up on that. At least in the next few years or so we should be able to pick up on economic growth, lucrative activities, and be able to boost ourselves. Or we could stick around and continue scrounging for opportunities where we are not only a relaxed culture, no, but there's also no money in the economy, no less opportunities, maybe. So I think it's as much as we would want to let this to the government to pick maybe or to choose, we also will be affected. And I think it's also okay that we can also voice out our views, as just the general public. And so I think we should settle for this direction where we're going to be more economically, productive, and we're gonna, be able to stimulate the economy at the end of the day. I think, it seems not very relevant now, but when right steps are taken at that particular time, when an opportunity presents itself, the results thereof are going to be so fruitful that people now be appreciating later on. But the time to make a decision is now.
So I think the question we need to ask, because I'm circling back here. How much is a bag of mili meal in Congo? Okay, how much? Because this is the reason why you're seeing what we call smuggling happening here. How much is a bag of mili meal in Congo? Because that actually makes a lot of sense as to why people are smuggling at the borders. Okay, because people are going to say no, but then why do Zambians keep smuggling? So in early March, so I'm just going to read this out. In early March, a 25 kg bag of maize was sold for $11.21. Okay, $11.21. This week, the same bag sold for 40. This week, the same bag sold for 92,000 Congolese francs for $40. So this is why, and I'm just going to read a story here, Vernon, just to try and get the mentality of it. The decision by Zambian authorities to cut maize exports is hurting Democratic Republic of Congo, whose southern region considered the grain a staple food, and they relied on Lusaka and South Africa for years of supply. Now, authorities in DRC want Lusaka to reconsider its decision, with officials from Kinshasa saying that the deal in the black, the deal that they want a deal in black and white to protect the future of food to prevent shortages. Shortages of maize are hurting the locals, which they want to buy. So without Zambian maize, look at the prices here. Without Zambian maize, their prices of maize go $40 a 25 kg bag. Okay, let me put that for you in kwacha, my friend. That is over 560 kwacha for a 25 kg bag of maize. Okay, you're crying about 200. Yeah, these guys are paying 560. Okay, that's what their market is like without Zambia. So why do you think Zambian farmers and Zambian producers are willing to take bags of maize and send it that side? It got to a point a few years back in 2016, Vernon, where people were buying maize here for 100 kwacha and they were smuggling it across the border for 400 kwacha. Okay, this was the greatest trade in town. Okay, so that's why they were doing this. So that's why I'm telling you that I understand where they are coming from. So the question is, it will cease to be smuggling if we just opened an economic border. If it became one economic zone, it ceases to be smuggling and it's one activity. The dollar also, because what happens is when the dollar in Zambia gets weaker, the dollars that Congolese are willing to pay for those things increase the kwacha prices. Therefore, now it incentivizes the removal of supply from Zambia, taking these things straight to Congo. This is what always happens. So one of the risks of the Zambian food supply has always been that when our currency gets weaker, the prices in Congo become more attractive. And therefore it shifts, whether it's tomato prices, whether it's goats, whether it's maize, whatever it is, it shifts to Congo for trading activity. But if you then have one currency zone, that threat stops existing and the inflation brought on by regional demand stops happening. So that's why that's why it might be of good to us to consider the people who are buying our things, perhaps joining into an economic union with them. That might protect us in the future. Okay, it might actually protect us. And also, one of the things that will happen is because you have multiple countries sitting with one currency, that currency is going to become a lot stronger because most of the time, Vernon, what happens is that your kwacha is controlled by copper. If copper prices are underperforming, then the kwacha goes down. If you have multiple countries connected under a single currency, what happens is that your currencies now become multi-commodity. In other words, it's not just one price that'll affect it. It'll be copper. Many commodities have to go down together to affect the strength of that currency. That's why you've noticed, Vernon, countries that are mainly reliant on a single commodity have got volatile currencies, while countries reliant on manufacturing or multi-commodities have got steady currencies. So if you look at your greatest export, if the majority of it is a single commodity, you often find that's a very volatile currency. But if the majority of your exports are multi-commodities or manufactured goods like the Western or developed nations, or let me say the northern developed nations of the world, they are manufacturing and multi-commodity export-based nations. And as a result, you start to see that their currencies are far more resilient, except for the oil nations, maybe the Saudis and the Russians. So that's just something I wanted to put out there. We'll come back on the other side of the break, Vernon, to finish this conversation on where we are with our economy. And then also, I'll be looking through a banking outlook and just a few things on essentials on business before we round. So catch people on the other side of the break.
Alrighty.
Right, so thank you very much for getting us back there. Now, back onto this side, let's just go into our final stories here. Our chart of the day, Vernon, is this, as I pointed out to everyone. They are racks. There's an old song I remember that got released somewhere in 2011 by a guy named Young Chris called Racks on Racks on Racks. So it does appear that they are racks that have hit Zambians' hands. 5 billion kwacha to be exact. And I keep asking myself, what has become of this money? 1.3 billion in NAPSA retirement withdrawals, 800 million in Zambia National Provident statements. By the way, this 1.3 billion is probably risen up by another 100 because I did point out earlier today that 100 million kwacha was withdrawn from NAPSA just between 5 p.m. and 9 p.m. just a few days back. 4 hours, people. You Africans withdrew. My goodness, this is hunger for cash. But I have said that look, do it as you need it. Please make sure you be tactical with it because it's a single withdrawal. You don't want to regret it. And 3 billion worth of dismantled arrears going into companies that have been having payments not being made. Government is now paying off individuals and companies who it owes for services. So we are seeing that 5.1 billion has been injected back into the economy in the first 4 months of the year. Going into another story very quickly, Vernon, here is the roundup of the top two banking titans in the country, Zanaco and Absa, as they came in earlier today. We have seen that on year-on-year basis for quarter one data, Zanaco financials in terms of interest up 1.12 billion kwacha. That's how much they generated, up 20.7%. Absa's revenue is up 702 million kwacha in terms of total interest income, up 26.5%. So you can see more aggressive growth happening in Absa than Zanaco in terms of the top line growth itself. However, the change comes in non-interest income. You did see that Zanaco's non-interest income was up 67 million, mainly due to trading commissions. However, one of the quick interesting lines here, Vernon, if you go back to interest income, is securities trading. In other words, government securities. You have seen that Zanaco's government securities income is at 640 million. In other words, they're making more money on government bonds than they're making on lending to the public, while Absa is actually making more money lending to the public than on government bonds. And we have to kind of be careful about these banks that are becoming bond shops at the moment. So one of the things is, yes, Zanaco is leading in terms of profits. If you look at the bottom, Zanaco's profits are about 410 million kwacha just for the quarter. They're on track to now get somewhere between 1.6 to about 2 billion kwacha worth of profits by the end of the year. Already they cracked 1 billion just a year ago. They're already heading for 2 billion, and Absa and Zanaco are on an arms race to get to who can get to 2 billion kwacha in bank profits. It looks like it's going to be another astronomical year. Both of them have experienced strong growth in their securities division, with Absa up 25.27% and Zanaco up 29.6%. In terms of this is our Q1 banking performance. However, it's the non-banking, it's the non-interest income where Zanaco takes over, where you've actually seen a 67% year-on-year growth in their non-interest income, which is 470, and that was mainly because of realized trading gains in FX and also commissions. But you did see as an Absa maybe faltering there in terms of their realized trading gains. They only grew up by 37%, while Zanaco's grew by 147%. So the FX division of Zanaco also did very strongly there. Now, finally, if you look at the baseline, it is the profits, the game of profits. Profits after tax have moved up by 54% year on year by Zanaco and 50.89%. You can literally see this is a neck and neck race between the two biggest banks of Zambia as who's going to get to 2 billion. But one of the things you'll find with Absa is a higher margin business. Though I think this year you did see in the first quarter, due to high non-interest, there was 100% growth in non-interest expenses. That grew by about 100%, bringing their margins down on the quarterly basis. Their margins were sitting somewhere around 50%, down to about 37.56%, while Zanaco's margins have maintained a decline of about 8%. So Zanaco's margins also sitting at 26%. So Zanaco is a bit more inflation sensitive. They're a bit more interest rate sensitive. So also, if you start to see the future of this bank starting to get curbed. So now if there is a deal, so in the short run, here's what I can see. Zanaco is the most likely to pass the 2 billion mark, because if there is a deal, Okay, if a debt deal does come about in Zambia, we are likely to see that the value of their bonds will spike, and they'll be able to trade them on the secondary market, and they'll benefit from that. However, on the flip side of it, if we don't see a deal, they're going to keep benefiting from the higher interest rates, especially due to a lack of NAPSA participation. So either way, in the short run, they're most likely to make it here. ABSA still has very strong margins of about 37%. So between these two, like I said, this is I wouldn't say it's not a David and Goliath battle, to be honest. It's a Goliath and Goliath battle, because these two pretty much make up half of the profits in the banking sector. Okay, these are big, big, big banks. Okay, they almost, like I said last time, I think they make up about 40% of the profit sectors. Both women run banks, and these are very aggressive women in the way they run these banks. Very aggressive. And you can see the levels of growth these two banks are pushing. And it's an interesting time to see it in Zambian history. And the two biggest banks at their biggest stage of growth are both run by two very resilient and powerful women in the banking sector. And they're proving themselves. Okay, they're actually proving themselves in terms of the results that they're cranking out here. So it's actually quite strong. But in combined figures, we'll be getting the banking sector figures as we go along later. Going into quickly, Vernon, I would say our topic of discussion today is focusing on the essentials in business. For entrepreneurs, I wanted to bring this up of focusing on business essentials. So last time I gave you this story that there are 6 stages your business is going to go through. If you're an entrepreneur, write this down. Found a market fit. Are you a right fit for the industry? You as a person, do you have experience in that industry? Do you have a personal story? Do you have an obsession with the problem? Are you the kind of person who's socially tied to such an industry? Like, do you easily network in that kind of industry? I'm reading an old classic here, Vernon, by Dale Carnegie, How to Win Friends and Influence People. And at the beginning of the book, they actually say that 85% of a person's financial success is determined by their social skills, not their technical skills. Technical skills play about 15% of a person's role. And they actually did this by studying the financially successful and looked at what they leaned to. 85%. Actually, in fact, even in there's a chapter in Sunny Zulu's Eccentric Thoughts, he actually talks about this, where he talks about the unwritten syllabus, the untaught syllabus, that no matter how much we teach you in school, at the end of the day, your biggest hurdles are going to be navigating people. Okay, it's your social skills, your ability to sell, your ability to lead, your ability to manage. Those things are going to determine your outcome as a person. So are you able to fit into a certain industry? The other thing you also want to look at is then once you've figured out that you're a fit for the market, then the question is there a lucrative problem that you have found? And then have you crafted a solution to it? Now, the mistake people do is they do solution problem fit. They find cool technology and then they look for a problem to solve that technology to. When what you should be doing is finding a lucrative growing problem that is driven by a social change. There should be something happening, a social demographic that's happening. A lot of people start businesses, Vernon, based on an economic change. Maybe the GDP has grown, but then when the GDP shreds, their whole business goes down. So I always urge people, start your business based on cultural, social, and technological factors. Those are non-cyclical factors. In other words, they don't move with the cycles of economy. Those are factors that move consistently. Is it the growth of the youth? Is it the growth of use of mobile phones? Is it internet use? Is it people now obsessing about financial freedom and financial literacy? Are they cultural, social, or technological changes that will actually lead to you doing a lot more, to the growth of your business? What's driving the growth of that problem? And if you have the skills and the idea and the foresight to go into that, and you're fit to solve that, then solve it. Okay. Usually the question is, are you convicted enough to try and solve it? That's maybe a question you need to ask. That's both a spiritual and a marketing question. That's a question I saw preached by a gentleman named Pastor Andy Wood of Saddleback Church, who was saying, if you want to get a dream for something and become a solution, you first have to go through a stage where you are curious. He says you are curious, then you are concerned, then you are convicted, where you take ownership of it. While on the other side, I was actually going through a training session by a lady named Alex Catoni on how to create a brand voice, and she said a brand voice that convinces people must first be convicted about the problem. So you can see this feeling of being convicted to solve a problem, to spot a problem that is driven by demographic, by social, technological, and cultural changes in society, and then equally you are convicted to solve that problem, and you are able. So you are able, convicted, and it's a problem that is driven by those factors. Ding, you've got a hit point. Now draft a solution around it. First, you have to develop whether it's a tar pit problem, where it looks like it's something that everyone goes to, but it's one of those areas, Vernon, where everybody tries to solve it and everyone dies trying. Okay, you have to watch out for those. Those are actually called tar pit problems. I would advise you go to Y Combinator Startup School. They actually teach about tar pit problems and how to avoid them, and what to see. So you want to try it, because a tar pit's kind of drain people in. Ends up being a graveyard of businesses and entrepreneurs. So you want to then solve the problem, starting with a minimum viable solution. You don't have to come up with a perfect solution. Just come up with a basic solution to it. Then the next thing you want to try and do is look for a team vision fit. Do you have a team, Vernon, that can fit with your vision? Do you have people who are aligned with you mentally, who you can kind of work with and spitball ideas off of? Maybe start this over the weekend with some like-minded people, because most startups work better in teams than as individuals. Most startups work better in teams. And I know people don't like this thing of working with other people because we like all the glory to ourselves, or we've been burnt before by someone and then we just don't want to do that. But the reality is the majority of successful startups are done in teams. So finding a team member is worth all those battle bruises and scars that you're going through. And then finally, product market fit. Turning that solution into a product by dropping an MVP, taking it through what we call the 6S of customer satisfaction, figuring out how now people can see your product, how they can signal they're interested, how they can start using it, how they can stay using it, how you can sell more of it to them, and how they can start spending more on it, and how they can sell it to their friend. So once you can take someone through those 6 stages of customer fulfillment, they're gonna keep giving you feedback, and you're gonna keep improving the product. And finally, you're then going to create a business model that suits the market for you to be able to deliver your product. And finally, a brand that now becomes part of the culture. So you've seen, Vernon, that, for example, these taxi applications in Zambia, these taxi applications have actually become a part of the culture. So I'm giving you the essential breakdown of the story of how this goes down in terms of business. But you've noticed that these taxi apps have actually become a part of youth culture. It's a part of now how we go out. It's a part of how we meet each other. It's actually become part of our lexicon, the 2 main brands of taxi apps. When a product becomes part of speech, it's now woven into culture. So you want to get to a point, Vernon, where you're part of the way people do things. You are the way, the truth, and the life, for lack of a better terminology, of something that people need to get done, like Google is, or like those taxi apps, or like Nshima is, whether it's a brand or something, whether it's a specific store, whether it's a place to go in the evening, whether it's specific kinds of clothes. If you are part of the way people live their lives, now you've kind of infused yourself. But too many people start by trying to be part of the way instead of eventually getting there. So that is the essential story I wanted to give you, of building a business on that trajectory of starting by, are you a fit for the market? Can you find a problem that's lucrative? Find a solution that fits it. Build a basic team. Build a basic product. Improve that product. Build a business model. Then build a business around that. And then build a brand. So you remember, you don't want to go straight to building a brand. Build the idea, the team, the product, the business, then the brand. Those are the stages you follow. People tend to skip stages, Vernon. That's why they get burnt. Don't skip stages.
Yeah.
Build it according to it. And I'm going to
All
leave
right.
it there.
Thank you.
Cheers. Have a good day.